by SEC. 2. Miller Energy. The company is ordered to pay a $5 million civil money penalty. To Boyd, he was ordered to pay a $125,000 civil penalty. He was also barred on practicing before the SEC as an accountant for 5 years, and another barred from acting as a director and officer of a public company for 5 years. Paul was ordered to pay the same as Boyd, which is $125,000 civil penalty. He is also got a bar from acting as director and officer of a public company for 5 years. Vogt, he got a bar on practicing before the SEC as an accountant for 3 years. And what should those individuals have done? For Boyd, as a CPA since 1993, he should have strictly followed GAAP standards, provided explicit and clear requests to Paul, a non-accountant with no formal accounting training, for reports in valuation, and reconsider the consequences even if Paul intentionally provided incorrect numbers and reports to him, ensuring an accurate valuation of the acquired asset. For Hall, I think he should have provided accurate and realistic data based on market conditions and historical performance. He also should inquire for more details when Boyd vaguely expresses his request for numbers to be written in financial statements. For Vogt, I think he should have conducted a thorough and independent audit, provided an additional procedure and tests when the reserve report and insurance placement cost report were used to determine the fair value of the acquired assets, and verified the assumptions and methods used in the valuation. Those individuals should have ensured that the assets valuations were conducted according to standard accounting principles and implemented stricter internal controls and transparency to avoid misleading investors and stakeholders. Be integrity and act with due care for all jobs done, whether they are CPAs or not. Especially Boyd and Vogt. They have been CPAs for over 10 years. So they should have make sure to adhere to professionalism, serve the public interest, act with integrity, be objective and free of conduct, act with due care, and possess adequate training and skills. Why do those people make the wrong decision? I had 3 speculations below, which may not be right. It's just my guess. Based on the information that in August 2008, Miller Energy named its founder's son-in-law as CEO. 2 weeks later, Vogt was hired for audit. Miller Energy acquired the Alaska assets in 2009. My first speculation is the previous CEO knows everything while the new CEO doesn't. So they got a chance to misstate financial reports and make the Alaska subsidiary look profitable. My second speculation is the new working environment under the new CEO's management is aggressively toxic so that it enticed them to produce fancy financial statements, which can attract new investments and boost stock price. And the last one is Miller Energy has reported a net loss for 7 years. The business may not be able to persist if the situation does not improve, especially in work. Individually, I felt Floyd was influenced by the desire to present a more favorable financial position of the Alaska sub or the company, possibly pressured by the environment and expectations within Miller Energy. For Hall, I think he may be influenced by the continuing loss of Miller Energy's Alaska operations. And then lastly, for Boat, I think he was just due to a lack of professional skepticism, due diligence, objective, and integrity. And what I learned from the case is accurate and honest financial reporting and auditing are crucial for maintaining trust and compliance with regulations. And also the necessity of thorough investigation and verification in financial reporting and auditing. Another one is the critical role of skepticism and the independence in auditing. And also senior management's commitment to integrity and ethical behavior is important. They should set the tone at the top to prevent fraudulent activities and ensure the integrity of financial statements. Last one is to stick to the facts. Rely only on verifiable data and evidence that adhere to GAAP standards, and avoid getting too involved with the business to manipulate accounting records and financial statements. To avoid pitfalls similar to what happened in the case happening in the future, it is essential to commit to follow GAAP and PCAOB standards rigorously. Ensure comprehensive evaluation and verification of all financial reports and evaluation. Maintain transparency and clear communication with all stakeholders to build and sustain trust. Stay updated with the latest accounting and auditing standards and practices. Always seek independent verification of critical financial data and assumptions. Foster a culture of ethics and integrity within the organization to resist pressure to manipulate financial data. Approach audits with a critical eye, questioning assumptions and data provided. Advocate for and implement strong internal controls and auditing practices. By focusing on these areas, the pitfalls encountered in the Miller Energy case can be avoided, ensuring a more honest and transparent financial reporting environment. And very lastly, thank you very much for your time and patience. I'm very sick those days, so I might have some interruptions in the presentation again. So I really apologize for that, and thank you so much